If you're watching this, you've likely realized that the old rules of money have officially changed. Welcome to 2026. We have finally moved past the era of runaway inflation and entered what economists are calling the new normal. It is a landscape defined by post-inflationary stability, but it's also more complex. Today, AI-driven algorithms are the primary heartbeat of market volatility, meaning the market moves faster and smarter than ever before. But here's the incredible news. You don't need a massive windfall to get started. In 2026, $1,000 isn't just pocket change. It is powerful seed capital. Because we're in the era of total fractional share ownership and zero-fee trading, that $1,000 gives you the exact same diversification power that used to require a six-figure portfolio. The real secret to 2026, however, is a fundamental mindset shift. We are moving away from the old-school habit of just saving and moving toward strategic asset ownership. In this economy, holding cash is a losing game. Owning a piece of the companies and technologies shaping the future is the only way to build real wealth. Today, I'm going to show you exactly how to deploy your first $1,000 using my three-step Wealth Foundation framework. We'll cover how to stabilize, how to diversify, and how to automate your growth. Let's get to work. Before we buy a single share of stock or a fraction of an ETF, we have to talk about the pre-investment audit. Think of this as the structural inspection of your financial house. If the foundation is cracked, your $1,000 investment won't build wealth. It will just be a temporary Band-Aid on a sinking ship. The first rule of 2026 investing is the debt versus investment calculus. Math doesn't care about your optimism. If you are carrying a credit card balance at 22% interest or a personal loan at 12%, and the market is historically averaging 8 to 10%, you are mathematically losing money by investing. Paying off high-interest debt, anything above 7%, is a guaranteed, risk-free return on your capital. In this economy, clearing that debt is the smartest investment you can make. Next, you need what I call a micro-emergency fund. I don't want you to invest your only $1,000. I want you to invest your second $1,000. In a world of instant payments and gig economy volatility, life moves fast. If your laptop dies or you have a medical emergency and all your money is tied up in the market during a downturn, you'll be forced to sell at a loss just to survive. Having $1,000 in a high-yield savings account before you touch the market turns a potential disaster into a mere inconvenience. It protects your portfolio from your life. Finally, we have to get your head right. The 2026 market is defined by high-frequency moves and AI-driven volatility. You will see red days. You might see your $1,000 drop to $800 in a single week. To survive this, you need a 5-year minimum horizon. If you need this cash for a house deposit or a wedding in 2027, stay out of the market. Ask yourself, are you a conservative builder who values sleep over high returns, or an aggressive growth hunter who can stomach a 30% drop for the chance at 10 times gains? Identifying your investor personality now is the only way to ensure you don't panic sell when the charts get messy. Once your debt is handled, your cash buffer is set, and your mindset is locked in, you're ready to actually deploy that capital. Let's move to step 2. Now that your head is in the game, we need to talk about the where. In 2026, where you put your money is just as important as what you buy. You can have the best investment strategy in the world, but if you're leaking 20% of your gains to the IRS or 1% to hidden platform fees, you are running a race with a weight vest on. Your first priority should always be tax-advantaged accounts. For 2026, the IRS has adjusted contribution limits upward again to keep pace with inflation. If you have a 401k at work with a company match, that is your first stop. It is literally an immediate 100% return on your money. But for the rest of that $1,000, look toward the 2026 Roth IRA. The limit has likely climbed toward the $7,500 mark for most of you. Because a Roth uses after-tax dollars, every penny of growth and every dividend your $1,000 earns is tax-free when you retire. In a world of shifting tax brackets, that tax-free status is the ultimate hedge. Once you know the account type, you need a platform, and the landscape has changed significantly over the last 2 years. You essentially have two paths: the AI pilot or the pilot seat. If you want to be hands-off, the 2026 breed of AI-driven robo-advisors is incredible. They've moved beyond simple rebalancing. They now use predictive algorithms to manage tax loss harvesting in real time. Platforms like Betterment or Wealthfront have integrated deep AI to ensure your $1,000 is spread across the global market based on your specific risk profile. However, if you want total control, the old guard, Fidelity and Charles Schwab, have stayed dominant by offering zero commission trades and massive educational resources. But keep an eye on the super apps. By 2026, the line between your bank and your brokerage has almost disappeared. Apps like SoFi or even integrated Apple Finance platforms allow you to move money from your paycheck to your portfolio instantly. This frictionless investing is great for consistency, but be careful. The easier it is to buy, the easier it is to panic sell. Finally, we have to talk about the silent killers: fees. In 2026, zero commission is the standard, but platforms are getting sneakier. Watch out for platform subscription fees or AI management surcharges. If you're only investing $1,000, a $5 monthly subscription fee is actually a 6% annual hit to your capital. That's devastating. Always look for the expense ratio of the funds you buy. If it's higher than 0.15%, you're paying too much. Your goal is to keep your overhead as close to zero as possible so that every cent of that $1,000 is working for you, not your broker. Pick your vehicle wisely, because this is the foundation everything else is built on. Now that you've picked your platform and avoided those hidden fees, it's time to talk about the actual blueprint. Most beginners make the mistake of treating their first $1,000 like a lottery ticket. They put it all on one hot stock they saw on a social feed and hope for the best. In 2026, with the market moving faster than ever, that is the quickest way to end up back at zero. Instead, we're going to use a professional framework called the core and satellite strategy. Think of this like a planetary system. You have a massive, stable sun in the center that provides the gravity for your portfolio. And then you have smaller planets orbiting it that provide the extra heat and growth. This strategy is designed to protect you during the inevitable market flash crashes, while still giving you a front row seat to the massive technological breakthroughs we're seeing right now. The core of your portfolio should be exactly 70% of your money. So, out of your $1,000, $700 goes here. You aren't looking for the next big thing with this money. You're looking for the whole thing. I recommend a total stock market index fund like VTI or an S&P 500 ETF like VOO. Now, I know what you're thinking. Isn't the S&P 500 kind of old school for 2026? Actually, it's the opposite. By now, every single company in the S&P 500 has been forced to fully integrate AI into their operations just to survive. When you buy the broad market today, you aren't just buying legacy companies. You're buying the massive productivity gains that AI is handing to every sector, from retail to manufacturing. This 70% is your sleep well at night money. It's the foundation that ensures that as the global economy grows, you grow with it. Next, we move to the growth satellite. This is 20% of your portfolio, or $200. This is where we get a bit more aggressive. In 2026, the S-curves of several technologies are finally hitting their vertical phase. You want focused exposure to the sectors that are currently leading the charge. Specifically, look into ETFs focused on applied AI. These are companies not just making the chips, but actually using AI to solve massive problems in logistics or law. Alternatively, you could look at green energy infrastructure or biotech, which has seen a massive surge thanks to AI-driven drug discovery. This 20% is meant to outperform the general market. It's higher risk, yes, but because it's only a fifth of your total investment, a bad month in biotech won't ruin your life, but a great month could significantly accelerate your path to your next $10,000. Then, we have the wild card. This is the final 10%, or your last $100. In 2026, we have to acknowledge that the traditional financial system looks a little different than it used to. This 10% is your hedge against currency fluctuations and institutional shifts. For most beginners, this is the spot for Bitcoin or perhaps tokenized real estate. Bitcoin has increasingly become a digital gold for the modern portfolio, a place to park value that isn't directly tied to the decisions of a central bank. If you're more interested in tangible assets, 2026 has made it incredibly easy to buy tokenized fragments of commercial real estate. Either way, this 10% is your insurance policy and your moonshot rolled into one. Now, you might be looking at that list: VTI, applied AI funds, biotech, Bitcoin, and thinking, how on earth am I supposed to buy all of that with only $1,000? A single share of some of these companies costs more than my whole budget. This is where the power of fractional shares becomes your best friend. In the old days, if a stock was $500, you had to save up $500. In 2026, that barrier is dead. Every major brokerage now allows you to buy slices of stocks or ETFs. You can literally put $10 into a high-priced tech stock or $50 into a diversified index. This is a game changer because it allows you to be perfectly diversified from day one. You can take your $1,000 and spread it across 10, 15, or even 20 different assets with surgical precision. By using fractional shares to build this core and satellite structure, you aren't just buying stocks. You're building a resilient, modern financial engine. You have the stability of the broad market, the excitement of high-growth sectors, and the protection of alternative assets. You've successfully turned $1,000 into a professional-grade portfolio. Now, we just need to talk about how to manage it. without letting your emotions get in the way. Now that your $1,000 is working, the biggest threat to your success isn't a market dip, it's your own psychology. To win in the long run, you have to move from being an active investor to being a system manager. This is where we trigger the flywheel effect. The first step is setting up dollar cost averaging, or DCA. If your initial $1,000 is the seed, the $100 you commit to every month afterward is the water and sunlight. In 2026, this is the real secret to wealth. By automating a fixed amount every month, you stop worrying about whether the market is too high or too low. You're buying more shares when prices are cheap and fewer when they're expensive, all without lifting a finger. This turns investing into a subscription service for your future self. Next, you need to turn on your dividend reinvestment strategy. Most modern platforms now allow you to drip your earnings automatically. Instead of having small cash payments sitting idle in your brokerage account, the system immediately uses that money to buy more fractional slices of your holdings. This creates a loop where your money is literally birthing more money, which then goes to work for you instantly. But here's the hardest part: the check-in schedule. In a world of 24/7 financial push notifications, the most successful investors are the ones who delete their trading apps, or at the very least, stop looking at them. You should only be reviewing this portfolio once a quarter, not once a day. Professional wealth is built in seasons, not seconds. Finally, let's talk about scaling from $1,000 to $10,000. Use the auto increase feature that is now standard on almost every major investing app. This feature allows you to schedule a tiny 1% or 2% increase in your contributions every 6 months. You won't feel the difference in your daily budget, but it's the fastest way to accelerate that flywheel. You've built the engine. Now, automation is what keeps it running until you hit that $10,000 milestone and beyond. Now that you've built that engine, I want you to step back and look at the horizon. Because that first $1,000 isn't just a one-time investment, it is a seed that fundamentally changes your financial trajectory. Let's look at the math of what that seed can actually do. If you leave that $1,000 alone and it earns a historical average of 8%, in 10 years, it doubles to over $2,100. In 20 years, it's $4,600. In 30 years, that single $1,000 seed has grown into nearly $10,000, all without you ever lifting a finger again. Now imagine the trajectory when you're consistently adding to it using the automation we just talked about. But to reach those numbers, you have to survive the 2026 news cycle. We are living in an era of constant information overload, where every notification is designed to make you panic sell or chase the next shiny object. The most successful version of you 10 years from now is the one who chooses discipline over drama today. Sticking to the plan is your only job. Stop waiting for the perfect moment or the perfect market conditions. Perfection is the enemy of progress. If you haven't opened that brokerage account yet, do it today, not tomorrow, not when you've done more research. Today. Now, go execute.